Morning, everybody. 9:05. Let's go ahead and get started. Hope everybody's had a good start to the week. We're wrapping it up here, approaching the weekend. Always nice. So today we're going to get into talking about stock valuation. The last couple times we've been together, we've talked about bond valuations and how we use the future value of money, time value of money calculations in order to determine the price of a bond, as in the sum of the two components of the sum of the present value of all the coupons that you're going to receive, as well as the present value of the future lump sum that you get returned to you when the bond matures on its maturity date. So today we're going to talk a little bit about how stocks are valued. Along the same lines, you'll see the future value, the time value of money formula, just in a little different lens today, to give us some idea of how stock prices are calculated. You know, probably that's something that we're more familiar with compared to bonds, right? I think we all kind of had an idea what a bond like conceptually was, but up until, our lectures, you probably didn't understand how the prices were calculated. But everybody's kind of probably seen what the stock price of Apple is, or Tesla, or Netflix, or DraftKings, or Next Era Energy, whatever it is. You've probably seen those prices a whole lot more frequently than you have bond prices, simply because the equities market is a much more traded, much more liquid, much higher volume market than the bond market itself. So let's go ahead and get into chapter 8. We're going to talk today about how stock prices are calculated, right? And how the stock price is really dependent upon the future dividends, right? And how those dividends grow over a period of time. We'll talk about using the price to earnings ratio, okay, the PE ratio, and how multiples are used in determining the price of an equity. We'll talk a little bit about kind of the election process for the boards of directors, statements, and the rights that you have as a common stockholder when you purchase common stock on the markets. And then we'll get into just a little bit about how the stock markets work in general. Okay, the equities market is a lot, I would say, I don't want to say easier to understand. It's just a lot more visible than the bond market, simply because that is what most average retail investors are looking at on a daily basis. And that's what you're putting your 401k money into. Even if you're looking at, the bond market as it relates to a particular holding within your 401k, you're still trading it as a mutual fund or as an exchange traded fund. Okay, so you're not going out and buying individual, very specific, Spotify issued bonds. All right, you're going to buy a basket of these bonds, and you're going to let somebody else deal with the in and out of the individual bonds that exist within those holdings. Okay, so today is all about stocks in the equity markets. So when we think about some of the features of common stock, you want to go out and you open up an account at Schwab and you want to start trading stocks, right? What you're doing is when you buy a stock, a single share of a single company, you're buying what's called common stock, right? And there are some features of common stock that exist that don't exist on preferred stock, okay? So when you buy a share of common stock, you get voting rights. Okay, so every year there are going to be things at the the annual shareholder meeting. There are going to be things that the companies are going to ask you as the shareholder what you want to vote on. What's your opinion on Apple spending $150 million on improving their green initiatives to go carbon neutral across all of their stores within the next 5 years? They're going to ask for your vote. All right, and you have the right to submit your vote to be counted, just like everybody else who owns a share of Apple or any other publicly traded company with common stock. So these voting rights get issued to you via what's called a proxy statement, and that's a statement that you'd receive in the mail detailing what all the decisions are that you have the rights to vote upon, and then you simply check a box and mail it back in, and you have successfully voted cast your vote, cast your ballot, voted your opinion on whatever issues the company is asking for shareholder opinion upon. Okay. There are different classes of stocks, and we have other rights that exist out there. Sometimes you have preferred dividends, okay, that could exist where you get paid before anybody else. Right? Sometimes in the event of a bankruptcy, you could have some claim, okay, to some of the assets within the firm that is going bankrupt or liquidating. Not always, but sometimes they do exist. And then finally, you get what's called a preemptive right. So if they're going to be issuing new equity, issuing new shares to the market, if you have preemptive rights, you're basically given the opportunity to purchase additional shares in order to not dilute your ownership percentage within the company. So you get preemptive rights to purchase additional shares in order to keep whatever percentage ownership of that company you had prior to those new issuances, okay, so that you keep yourself whole in terms of what percentage of the company you might own. By the way, the chat room is open, so if anybody's got questions as we go through here, please use the chat room. Okay. All right, so dividend characteristics. All right, well, dividends, as we've already talked about, right? Dividends are a management decision, after the operating period in question. Okay. Management takes a look at their net income, and then they have to decide what they're going to do with their money. Right? And they've got two choices, right? They can keep the money for themselves in the form of retained earnings, or they can pay that money out in the form of a dividend payment. So when it comes to a dividend, it's very important to differentiate between, interest expense that you pay on debt, all right? That debt is considered to be part of the management decision, and debt is used as a way to fund the operations of the business, and therefore the government says, because that debt is used in the operations of the business to generate revenue, we're going to give you the tax deduction that relates to the interest on that debt that you have. Dividends are not that way. All right, dividends are not a liability of the firm like interest on debt is, okay? Because dividends are a management decision, right? Until the board decides that they're going to pay a dividend, right? There is no liability, okay? Because they could choose to not pay one. They could choose to pay one at the same rate, pay one at the lesser rate, or increase their dividend. But it's not a liability until they declare the dividend. Once they declare the dividend, then it becomes a liability, because they have, at that point, they have made a commitment to the shareholders who owned shares of that company, okay, on the ex-dividend date or prior, okay, that they are going to get paid for the shares that they own in the company. So once they declare the dividend, all right, then it becomes a liability for the firm, okay? And firms obviously can't go bankrupt, all right, for not declaring a dividend, right? Because declaring a dividend, once you declare it, then it becomes a liability, and then you're obligated to, to pay that dividend, okay, most of the time, right? But they can't go bankrupt for not declaring a dividend, which makes perfect sense, okay? So with dividends and taxes, the dividend payments that the companies distribute to shareholders, okay, it's not considered a business expense, right? It's a management decision as to how they're using their money, how they're using their cash, how they're using their retained earnings. It's a management decision, okay? Therefore, they're not considered to be tax deductible, which is why you don't see dividend payments show up anywhere within the income statement itself, okay? Once those dividends get paid out to the shareholders, okay, those dividend payments are called ordinary dividends. Those ordinary dividends flow directly into the shareholder, into your 1040 tax form, and they come into your world as taxable income, okay? And depending upon what tax bracket you find yourself in, they get taxed at a particular rate, okay? So not only has the corporation itself essentially already been taxed on the money that they're going to pay out, right? Because they've already gone through the entire income statement all the way through taxes to get to net income. So they've already been taxed once, right? And then they have money left over from net income that they can either give back to themselves or pay out to shareholders in the form of dividends, right? So when they pay it out in the form of dividends to shareholders, again, that money flows into the shareholder tax returns and gets taxed again. So you kind of have this like double taxation situation that exists with dividend paying corporations. And we could debate the legitimacy of that for hours probably, but it is what it is. It gets taxed obviously at the corporate level as it flows through the income statement down to net income, and then it also gets taxed again when it flows to the shareholder in the form of ordinary dividends on your 1040 tax form. So when we think about different types of stock, we talked about common stock, right? You get voting rights, you have the ability to, hire and fire the boards of directors. But when we think about preferred stock, okay, preferred stock operates a little bit different because preferred stock, you're actually kind of laying claim to priority of receiving dividends. Okay, so you're always giving something up, right? There's always an opportunity cost in everything that we do, like we've talked about up to this point. Every decision that we make, there is a choice that has to get made, and that choice comes with a cost, okay? An opportunity cost. If we want to go to Starbucks and buy the $5, Frappuccino, right? We're giving up buying something with that same $5. We're making a choice that we'd rather spend our money on the $5 at Starbucks than $5 somewhere else. It's a very simple example, but same thing here. If you want to buy preferred stock, there are some benefits of buying preferred stock. First of all, they trade more like a bond. They're more sensitive to interest rate movements, okay? But they're not very sensitive to the overall market fluctuations that are occurring in the broad market itself, like you would see on the common stock. So you do get a little bit more stability, and you do get more of a, I would say it's not 100% guaranteed, but certainly more guaranteed stream of income in preferred stocks than you do simply with common stock, right? And preferred stock shareholders get paid before common stock shareholders. So in the event that there's a liquidity issue with a dividend paying company, okay, the preferred stockholders will get paid before the common stockholders. Okay. Again, just like with common stock dividends, preferred stock dividends, they're not liabilities of the firm, okay? And the preferred dividends can be deferred indefinitely. And what that means is, and it gets into the third bullet point, or the sub bullet here about cumulative dividends. So with the second and the third sub bullets, they're kind of talking about it together. If you have preferred stock, you are essentially guaranteed to receive the dividends at some point, okay? If the company stops paying their dividends, okay, your dividends begin to accumulate, okay? And it becomes even more of a liability for the firm, right? And once the company decides to reinstate their dividends, okay, all of those common stock shareholders have to wait, okay? And you, as a preferred stock shareholder, and every other preferred stock shareholder, if they have cumulative preferred dividends, once that dividend gets reinstated, okay, you get made whole on all those dividends that you missed during that period of time that the company stopped paying the dividend, okay? So in essence, you are guaranteed to get your dividend unless the company goes bankrupt, of course. But there's no guarantee as to when you're going to get that dividend check if the company halts their dividend payments, okay? So the key takeaway here is preferred stock doesn't have voting rights. Common stock has voting rights, okay? You understand the difference between the two of those for our check-in exam next Tuesday, or on this upcoming Tuesday, okay? So the check-in exam is Tuesday, all right? It'll open at 9 a.m., just like our normal class, right? It'll close down, all right, I'm going to leave it open for an extra hour, so it'll close down at noon. All right, it'll automatically submit whatever answers you've got at noon. Okay, it's all going to be handled via Connect. Do common stock shareholders get cumulative dividends as well? No, Nick, they do not. Okay, common stock shareholders do not get cumulative dividends. Okay, if the company decides that they're going to halt their dividend or cut their dividend, then the common stock shareholder gets whatever they get. Okay, and part of the, you know, the trade-off there, right, is that your hope when you purchase shares of a company, the reason why you're purchasing the shares of that company is because you want the value of that stock to go up. Okay, most people, some do, but most people are not buying shares of Apple or shares of Netflix in the hopes that the stock price stays flat and all they want to get is the measly 1.7% dividend yield, right? When we buy common stock, we want the stock price to go up because we want to make money. We want to get a higher rate of return than we could otherwise get by putting that money in a savings account at the bank. So common stockholders don't get cumulative dividends, okay? Because you're buying common stock because you believe there's more growth opportunity in the company than there is buying preferred stock that doesn't have much price fluctuation but pays out a consistent dividend, you know, every month, every quarter, every 6 months, every year, whatever it is. Okay, so preferred stocks trade more like bonds, okay, and common stock is what everyone is pretty much used to seeing when you go to Yahoo Finance or Market Watch or Bloomberg or wherever you get your financial information. Okay, answer your question, Nick?
Yeah, it did. Thank you.
No problem. Okay, so understand the difference between common stock and preferred stock. Right? And the markets themselves, right? This is a very oversimplistic next couple of slides that review the types of markets that exist. Well, the first one we've got is a New York Stock Exchange. Right? It's one of the ones that you're most likely to have heard. Okay? It's a physical exchange. Right? You can actually go to the stock exchange floor in New York, and if you haven't done it, you should go do it. It really is. It's very cool. I've been many times, but the first time I went, I was probably like 10 years old when my father had some business up in New York, and we had to go, you know, travel there, and he took me to the floor, and at that time it was crazy. Right? You've had all the people on the floor, all the dealers, all the brokers, all the market makers, the DMMs that you see here, the designated market makers, the ones that are kind of finding the buyers and the sellers, creating the prices. And then you've got the floor brokers who are bidding and asking for the shares that are being traded, and the ticker tapes, you know, when they say, you know, that we're going to have a ticker tape parade for the, you know, for the Lakers for winning the the NBA championship, right? Well, it's the tickers are what the name came from, the stock market, because on the floor of the stock market every day, like that would be the piece of paper that people would sign off on that we just closed a deal. Here's the buyer, here's the seller, here's the price it transacted at, here's the expense for the trade and all of that. And then once it was put into the system, it was done. So people just drop it on the floor, and then every day the janitorial staff would come through and they'd clean the floor and they'd put all these pieces of ticker tape, you know, into the trash, and they would save them for all the parades that would go through New York. So that's kind of where the name ticker tape parade kind of came from. All right, so it's a physical location, the New York Stock Exchange. You can go there, okay, on Wall Street, and I encourage you next time you are in New York to go and do that. It's very, very cool. It's the largest stock market in the world, right? And there's probably a little bit over 1,500 license holders as opposed to the 1,366 that are listed here. But it's comprised of different people who are there working to make sure we're bringing together buyers and sellers and keeping the markets liquid and functional and providing opportunities for people to offload positions, put positions on, take risk off, put risk on. Right? But you've got the market makers, you got the floor brokers, you got individuals that are called supplemental liquidity providers. So if people need to borrow money on margin or other types of borrowing, or other borrowing that might need to occur to get some supplemental liquidity. You've got a group of people that are there called the SLPs, SLPs. Okay. And then behind the scenes, you've got a massive, operations group that's making sure that the infrastructure, or the IT systems, the trades, everything is being properly handled and cleared and done in the fastest time possible. Okay. And there's actual physical floor activity going on. Certainly not like what it was 35 years ago, right? But there are still people on the floor of the stock exchange that are doing what they've been doing for 30, 40, 50, 60 years. It's really cool. You should definitely go check it out. All right, so then we've got the NASDAQ, right? You're also familiar with the NASDAQ, right? A lot of the, like this is kind of considered to be more of the technology exchange, okay, than the New York Stock Exchange. But it's not a physical exchange. You can't go to the NASDAQ floor, okay? You can go to the NASDAQ headquarters, right? But you can't, it's not a physical exchange like the New York Stock Exchange is, right? And it's all a computer-based quotation system, right? So if you're dealing on the NASDAQ, you can deal on the NASDAQ right from the computer in your own home if you have the proper license to do so, right? And you can tell the computer, what your bid size and your ask size is, which we'll talk about that in a second, but basically the volume that you're looking to trade, and it'll put your input, your numbers into their larger system, match those up with all of the other broker dealers that are putting their orders into the system, and based upon the orders that are coming into the system and at what prices for the bid and the ask, meaning the buy or the sell, then it will create the prices within the market, right? So we have 3 different levels of information that you can kind of have access to, right? So when you look at a level 1 quote, right, and you'll see this as kind of like marketing schemes from companies like Schwab or E-Trade. They'll say, oh, you get level 1 trading information. Well, what level 1 means is that you get the median quotes, okay, of all of the registered representatives and broker dealers that are putting their volumes and prices into the system. You have access to see just the median quotes, okay, in aggregate. You don't get broker level detail. Okay, you get level 2 access, then you get to start to see who is quoting what price and for what volume. Okay, so you get to start to see you have more visibility into what we call the breadth of the market. And then finally, you get level 3, all right, which is the highest level of access. And this is for dealers only, where you would be able to go in and physically view and update the quotes. So the buy side or the sell side for the particular equities that you personally are looking to transact upon. Okay. And again, the NASDAQ is comprised of a large portion of technology stocks. So if we're looking at Apple, I pulled this down this morning. Okay, so this is actually from the close yesterday. There's a lot of information here, and some of you may be familiar with what a lot of this information is. Some of you may not. So we're going to go through just real quickly what some of the most important, pieces are in terms of looking at a quote for a stock. All right, so this is just from Yahoo Finance, which, everything else that Yahoo does, sucks, but their finance site is actually one of the best ones that's out there. So if they could just keep this going and figure out a way to monetize that, Yahoo might actually be a fairly viable company, but everything else they do pretty much sucks. But their finance is great. So when we look at Apple, all right, and so we've got the name, obviously. We've got the ticker, AAPL. It tells us what exchange that it trades on, the NASDAQ. Okay, it's giving us real-time price, and then it's telling us what currency it's traded in, US dollars. So it's at this morning, okay, at the close, like yesterday at 4 o'clock, all right, it closed at 116 spot 87, which was down about 50 basis points from what it had opened at that morning. All right. This morning, okay, pre-market, all right, before the actual market opens at 9:30, okay, Apple was trading higher than what it had closed at yesterday. So it was up 11 basis points over what it had closed at yesterday. So early morning trading indicates that it could be a good day for Apple, at least in the positive and not the black, not the red. Okay. It tells us what it closed at previously, what it opened at, the bid and ask, right? So what we have here, right, there's two pieces. So you've got on the bid side, meaning that if you own Apple, if you currently own Apple and you want to sell Apple, okay, you want to sell the stock that you own, okay, the bid is the price that the street, that the NASDAQ exchange, okay, is bidding to purchase your shares. So if you want to sell your shares of Apple, you're going to sell those shares of Apple to the exchange at 116.92, okay? And they're looking for an 800 share size volume in order to get that price, okay? So not that you specifically have to sell 800 shares of Apple, okay? But when you do put in your order, okay, your order gets aggregated with all of the other orders that are out there, and this is saying that right now there's an 800 share block that people are looking to transact at 116.92. Okay. And I'll get to something here in just a second that'll give you a further idea of what this means. On the ask side, if you want to buy shares of Apple, meaning you don't own any or you want to add to what you already own, if you want to buy shares of Apple, the street, the exchange is asking 116.94, okay, for you to purchase new shares of Apple. And right now, okay, it's trading in a block of 2,200. So you can see there's a big difference in the breadth of the market between how many shares are kind of like, it's kind of a feeling of whether it's bearish or bullish, right? There's not a lot of sellers in the market right now because we've only got an 800 share block, but we do see we got a lot of buyers because we've got a block size of 2,200. So that spread between, well, what happens if the block isn't met? Then the price changes, and when the price changes, then the block size will change, Nick. And so it just kind of makes its way into balance. Okay, just mathematically, it'll make its way into balance depending upon the numbers of buyers and sellers in the market, and the number of shares that the buyers and sellers are looking to transact upon. Okay, so it will vary depending upon the supply and demand of the particular stock or equity that we're looking at. Right. So this is a kind of a big difference between the bid and the ask, right? So we've got a lot of buyers. We can see that the block sizes are much larger, okay, than we've got on the sell side. Okay, so when we look at that big difference, we can kind of tell that we should be in pre-market at least, which is where this screenshot was taken. We should probably see Apple's stock price being a little bit higher than it was yesterday, simply because they're looking to transact at 2,200 share blocks. And that spread is widening out, and that's kind of what we see, okay? You can't always look at that, but when there's this big of a disparity between the bid size and the ask size, you can usually see that reflected in a positive or negative. If it, conversely situated, you can usually see that evidenced in the, being in the money or out of the money for that given day. Okay. Gives us the spread of how Apple traded within the given day, a 52-week range. So if you'd bought Apple 52 weeks ago, you'd have paid $53.15. And the high over that 52-week range, the 52-week range this would have been the low price over those 52 weeks. This is the high price over the 52 weeks. So you kind of get a range of where Apple's been trading. Okay. You can see the volume of shares of Apple that are traded yesterday. Okay, so yesterday or this morning rather, okay, pre-market going into the market day. All right, there's already been 87 million shares of Apple that have been traded on the buy side. What's going on here? On the buy side as well as on the sell side. So it's an aggregate of the buy and the sell. If you take my 317 class, we'll actually get into looking at upticks, downticks, breadth of market, cumulative breadth of market, to see how a company is trending over a period of time and whether it's in a bullish pattern or a bearish pattern. We'll talk about momentum and some of the other technical analysis components, criteria, metrics, indicators that you can look at, but that'll be for a different day. Right? The average daily volume for Apple is around 174 million shares. Okay. And when you talk about how many shares are transacted on any given day within the market itself, I mean, you're talking about anywhere from 3 billion to 5 billion. Okay. Shares, total shares. All right. On the buy side and sell side. Okay. But it is, it's an exceptional number of transactions that occur. Talks about market capitalization. So Apple, based upon where it's opening at this morning, this number will push over $2 trillion. And market capitalization is nothing more than the stock price of the company multiplied by the number of shares that are outstanding within the market. So if you were to ask me if somebody was going to go and purchase Apple, okay, for, you know, what Apple was valued at, you know, the starting point for that number is market cap. Okay. So if somebody wanted to go think about purchasing Apple as a company, okay, they would start at $2 trillion. Okay. And then they would do more of a valuation of the company to see if there's a premium that they'd like to pay. But at the very least, they'd be looking at paying $2 trillion. Conversely, if Apple ever wanted to take themselves private, meaning they no longer wanted to be a publicly traded company, obviously, since we talked about the income statement and we have owner equity, right, and we have common stock, okay, you know, at the most simplistic level, the value of the common stock line item on Apple's income statement would be $2 trillion, which sits on the right-hand side of the balance sheet, right? So it is considered to be an overall liability for the firm. So therefore, if Apple wanted to take themselves private, okay, at a minimum, they would have to come up with $2 trillion in order to buy back all of those shares from the shareholders at the existing price. Okay, so we all know that the shareholders would demand a premium above the $2 trillion if Apple wanted to take themselves private. Okay. And we have beta. Again, take my 317 class. We'll talk about what beta is. And we'll talk about beta in the next couple of weeks. But basically, it's just kind of a measure of volatility against the overall broad market. Okay. So at this point, the broad market volatility would be a 1. Okay. The overall market has a general volatility, and we call that volatility beta. And I'll explain what beta is in a few weeks. But nonetheless, it's a measure of volatility. So Apple's got a 5-year monthly beta of 1.31. All right. This basically means that if the market moves up by $1, Apple's going to move up by $1.31. If the market moves down by $1, Apple's going to move down by the corresponding 31%. Okay, so it is a measure of volatility as it pertains to, or not really volatility, more like a covariance correlation between Apple and the overall broad market. Okay, price to earnings ratio. Right? We've talked about this. Okay, we know what price to earnings ratio is, and we know what the earnings per share are. We did this. Okay, so earnings per share, we're going to talk a little more about what that is today and how we use earnings per share and what we call the PE ratio or the multiple, okay, in order to calculate stock price. So if you take the earnings per share, okay, and you take the price to earnings ratio and you multiply the two of those together, you come up with the stock price. Okay, could be a little bit off just based upon when they did the reporting. Let me just check my calculator here to see what that number actually is. Okay, 117.02, right? So it is pretty much real time based upon what's going on pre-market this morning. Okay, so their earnings per share, so net income divided by total shares outstanding, earnings per share, multiplied by their price to earnings ratio, so PE ratio multiple, okay, multiple times EPS gives you stock price. Okay, So we'll talk about how we go about using this multiple in terms of stock valuation in the next few slides. Talks about when they have their next earnings call, like when they're going to report their earnings to Wall Street. Okay, how much dividends that they're planning on paying in the future and what that yield calculation is. So right now, if you were to invest money in Apple and buy a share of Apple, your yield, the interest, if you will, that you would earn from Apple is about 0.7%, which is pretty low. You know, it's actually pretty low in relation to kind of my own personal feeling that Apple should be paying, you know, double that in terms of, you know, what their dividends look like, simply because of how much money they make, their cash position, their long-term growth potential, their services business through, you know, Apple TV and through their entire, you know, services business from the App Store that is significantly undervalued in the eyes of Wall Street. And just simply how much cash they have on hand. To me, they should be, this dividend yield, the dividend amount, the 82 cents a year, should be more like $1.60 to $1.70 a year, in my opinion. Tells us when they're going to go ex-dividend on August the 7th, meaning if you own shares of Apple on August the 7th or before, then you are entitled to receive the dividend that the board of directors may, keyword there, may elect to declare. Again, with Apple, there's no reason why they wouldn't declare the dividend. They have so much money. And then there's a forward 1-year price target estimate. Okay, I have 121.43. So it just kind of gives you a data point that here's what some of the Wall Street analysts are thinking in terms of what that 12-month time frame looks like for Apple and what that 12-month price target might look like for Apple. So they're projecting a 1-year price target at 121.43. Okay, so maybe a 5% change from where it is right now. So they're not really expecting a whole lot of growth. Okay, so that's kind of how you go about reading the basics of a stock quote. All right, and depending upon what site you're on, you'll have charts. And one of the things I do like about Yahoo Finance that other investment sites really, they don't have as a robust charting capabilities as Yahoo Finance does. Yahoo Finance has a very robust charting system that I really enjoy using. And that's pretty much every time I need to go look at some statistical or technical analysis, I usually always come to Yahoo just because it's easy to use and they do a good job with it. Everything else about Yahoo sucks, like I said, but the finance is pretty good. Okay, so how do now we're going to start piecing together how we go about thinking about the stock price. Okay, how do we come up with the price of Apple or the price of a dividend paying company? Right, so if you buy a share of stock, right, you're going to use your money. Okay, you're going to use your money. You're going to buy a share of Netflix or whoever, okay, DraftKings, and you're investing. You want to get a return on your money. Okay, so if you elect to put your money into the market, then you can expect to receive cash 2 different ways. Okay, you get cash that comes in the door in the form of a dividend. Okay, so you've got some projected future stream of cash flows that is related to the dividend payment. Okay, and the second way that you get money coming back in the door is when you sell that stock, okay, at some point in time in the future. Okay, you sell it to somebody else in the future, and then whatever you sold it for, that is positive cash flow back to you. Okay, see the correlation between this bullet and what we talked about in chapter 7 as it relates to bonds. Okay, the dividend payment that you expect to receive, you could equate that to the coupon payment of a bond. Okay, the price that you get when you sell those shares into the market at some point in time in the future, okay, you could equate that to the $1,000 face value that you get when the bond matures. Okay, so here we are again, time value of money. We're continuing to talk about present value calculations, right? I told you that it's a super simple formula, but it's a formula that is applicable throughout the whole course of this semester. Discounted cash flow valuation, you know, for project analysis, calculating bond prices, and now we're going to see the same time value of money concept applied to how we go about calculating the stock price. Okay, so just like with bonds, the price of the stock is the present value of those expected cash flows. So what's the present value of all those future dividends? And what's the present value of that price that I expect to sell that stock at in the future? Okay. So let's do a quick example here, just a real quick, like one period example, very simple, right? You're considering purchasing a share of more oil, right? You expect that it's going to pay a dividend in 1 year, okay? And you believe that you can sell the stock for $14 at that time a year from now, okay? You have decided that for you, you are going to require for you to even think about putting money into this investment, that you're going to need to get a 20% return on your investment, right? That's your goal. Like that is your cost of capital. That is your personal discount rate, right? That's what you want. You need something that's going to pay and deliver 20% total return. So what are you willing to pay today? All right, in order to get a 20% return. Present value, all right, equals future value divided by 1 plus the rate to the time period as the exponent. So what's the present value? How much are you willing to shell out? So think about the Excel formula. Remember, when you're looking at inputting a present value number into Excel, you put it in as a negative because that's cash out. How much money are you willing to pay today in order to get this amount of money in return? So price, present value, okay, present value is equal to the future value, and the future value is the price you're going to sell it at plus the $2 of dividend, right? So you're going to get $14 coming in the door, and you're going to get $2 coming in the door from the dividend. So a year from now, your future value, your future cash flow stream is 16 bucks, right? Divided by 1 plus the rate, so 1 plus the 20%, 1.2, okay, raised to the time period. Well, the time period's just 1, so there is no exponent. It is 1. So 16 divided by 1.2 tells me that the present value, okay, today, the value today of that $16 a year from now, with my required return of 20%, I would be willing to pay $13.33 for a single share of more oil today, right? I need more oil to be transacting, okay, at $13.33. And if it is, and I'm hitting my 20% required return, and they do pay that $2 dividend, and it trades at $14 a year from now, and I'm able to sell it at 14, then I have accomplished what I'm trying to accomplish. And I am willing to pay today $13.33 for a share of this company. Okay. Again, it's the same formula that you're used to seeing, the same formula that we've been talking about for 6 weeks, just being applied through a different lens. Okay. What if we decide that we're going to hold this stock for 2 years? Okay, what if we decide that we're going to hold the stock for 2 years? So we've got a 2-period example, right? It's no different, okay? You're doing the same thing that you did when you did the project valuation. You've got to calculate the future stream of cash flows for each period. So in this case, we've got the more oil, okay? And in addition to the dividend in 1 year, okay, the $2, right? You're expecting a dividend of $2.10 in year 2. Okay, so more oil is growing their dividend, right? And in year 2, now you're projecting that the stock price is going to be $14.70 at the end of year 2. Okay, so how much are you willing to pay? Again, think about this in terms of present value. The sum of all the present values tells you what you're kind of willing to pay for the stock. So we have the present value of year 1. So the $2 in year 1, our 20% return. 1 is the exponent, so we got year 1. Okay. And then we have the second year of cash flows, because we know we're going to get a second year of dividend, and we know we're going to sell the stock in the end of year 2. So we get $210 from the dividend, okay? And then we get the $14.70 from the sale of the stock, okay? Bringing it back into today's dollars, divided by 1 plus the rate to the time period. So 1 plus 0.2, 1.2 raised to the second power because we're in the second period. So again, here we are. Look at that, $13.33. Interesting. It's the same number. Somebody hit the chat room and see what, let me know what you think as to why that is. Okay. What if we held the stock for 3 years? Okay. Same thing. You calculate the present value of year 1, you calculate the present value of year 2, you calculate the present value of year 3, you add them all up and you get $13.33. Okay. So we went from 1 year at $13.33. We went to the second year at $13.33. And then we added a third period and we got $13.33. So we'll come back to why that is here in just a second. But if you've got any ideas, hit the chat room so I can see what you guys are thinking. Right? So when we think about developing the model that we're going to use in order to determine the stock price of a dividend-paying company, all right, we need to consider that we could always continue to push back the year in which we sell the stock, right? So we were looking at, we're going to sell it in 1 year. Well, then we're going to sell it in 2 years. But then we're going to sell it in 3 years. But then maybe we're going to hold on to it for 100 years. And we're going to sell it 100 years from now. Okay, so we can always make that decision to continue holding that stock for an infinite period of time, right? So when we think about how that relates to the present value calculation, right? The longer we push out that time period in which we're eventually going to sell the stock, right? The longer we push out this number, okay, from 3 periods to say 100 periods, right? In 100 periods, the exponent goes to 100, right? For that final 100th period, just like we did within the bond calculations. So in essence, that value, that like future sale of the stock 100 years from now on a present value basis is essentially nothing, right? It's essentially 0 because the discount factor is going to be so low that when you use that very low discount factor on that future sale value, right, it's essentially nothing. Just like we saw when we did the bond price calculation for those for Walt Disney's Sleeping Beauties. When they issued that 100-year bond on day 0 of issuance, the future value of that $1,000 100 years from now was only 60 cents. Okay, was only 60 cents. All right. So the longer that we push out the sale of a stock, the further out we're pushing out that return of money from the initial purchase. Okay, which essentially the longer that we go to infinity, that value essentially approaches 0, right? So what we're saying here is that in essence, okay, the value, the price that you'd be willing to pay for a dividend paying stock is nothing more than the present value of all the expected future dividends. Okay, that's really what we're saying here, is that the value of the stock, the price you'd be willing to pay, is nothing more than the present value of all those dividends, because we can always choose to hold that stock for infinity. Okay, and if we hold it to infinity, then the value of the future sale, okay, the cash that we would get from the sale of that stock at, an infinite time period from now is, for all intents and purposes, zero. So how do we go about estimating what those future dividend payments look like, right? So that gets us into the meat of today, as around like what types of growth models exist, so that we can apply those growth models to companies and determine what price we'd be willing to pay for those companies today based upon their projected dividend growth or no growth. So when we talk about estimating dividends, okay, we're really talking about three different types. Okay, constant dividend, or what we call the zero growth model. So if a company pays $1 of dividends every year per share, then they would continue paying $1 per year per share for the remainder of that corporation's life. Okay, so they're not growing their dividend every year. Okay, so that's very similar to a preferred stock, right? When you buy preferred stock, you're buying preferred stock at a particular dividend rate, 5%, 6%, 6.5%, whatever it is. Okay, that's how you're buying it. You're buying it like a bond. You're getting the same amount of money every single period that they pay preferred dividends. You don't get the benefit of an increase in dividends if the company decides to increase their dividend rate. Okay, so on a constant dividend, zero growth model, okay, the price of the stock, all right, is treated like what we call a perpetuity, right? We'll talk about what that is here in the next slide, right? Because you're not growing the dividend. It's very easy to determine what the price of the stock should be, because it's simply just the dividends that you're getting in that year divided by the rate, okay, for the required return, if you will, for the investment. Okay. And then we have the second bullet here called constant dividend growth, right? And this is where firms will say, every period, right, we're going to make a commitment to the shareholder that we're going to grow our dividend consistently every period by some amount, 2%, 3%, 5%, whatever it is, but it's going to be constant. Okay, we're going to do this forever. All right, every period that we pay dividends, okay, we're committing to the shareholder that we're going to grow our dividends by that amount consistently forever. So it's constant growth. Okay, and when we think about how we go about calculating the price that we'd be willing to pay today for a company that is using this growing perpetuity model, right? It's a constant growth equals growing perpetuity, right? We consider that to be the constant dividend growth model. And then finally, we've got something that you're not really going to be tested on, but you should at least know. It's called supernormal growth, right? Where the dividend growth at the very beginning is not constant, okay, or consistent for that matter. It could be paid one period, not paid the next period, paid more the third period, even less the fourth period. But the point here is that it's not consistent at the very beginning, okay? But at some point in the future begins to settle down, and then at that point begins to grow consistently after that. Okay, so when we get into supernormal growth situations, we have to do a multi-stage model, okay, where we split the cash flows into different sections, and we're able to calculate the different values of those different sections, and then we can sum everything up through the multi-stage model to calculate the price based on supernormal growth. But again, I'm not going to test you on supernormal growth. Just know that, this is fairly normal, okay, for companies, okay? Companies that are just starting to pay a dividend. It may take them a couple of years to really get into and establish more of a consistent pattern of paying that dividend. Okay, so this is not uncommon to see supernormal growth cases, within the market, right? Nor all three of these are fairly common, to be quite frank. So in a zero growth model, right, we're treating it like a perpetuity. Okay, so if we know that the dividends are going to get paid and expected if you're a shareholder at regular intervals, right, forever. All right, they're going to keep the same dividend payment coming forever, and they're not going to change the periods in which they pay it. So you got to have constant period, constant dividend. Then we can treat it just like a perpetuity. All right, and we can calculate the price today, okay, based upon the perpetuity model, which is simply nothing more than the dividends, okay, that are being paid, okay, adjusted for compounding, adjusted for time periods, okay, and we can calculate the current price today by taking the dividends that are paid divided by our expected rate of return. Okay, so in this example, suppose we got a stock that's going to pay 50 cents, okay, every quarter, right? And the required return is 10% with quarterly compounding, right? What's the price you'd be willing to pay for this company that's in a zero growth dividend model? Well, P0, price zero today, so price today is equal to D, the dividend, the 50 cents, okay, the 50 cents. They're paying it every quarter, okay, and your required return is 10%. That's 10% on the investment, right? So 50 cents divided by your R, your rate, so 10%, all right, adjusted for quarterly compounding, so 10% divided by 4. If you are going to make this investment and your required rate of return is 10% and they're paying 50 cents every quarter from here to eternity, okay, the price that you'd be willing to pay for that is $20. Okay, so the important thing here is when you see zero growth, okay, when you see zero growth, you know that you need to be treating it like a perpetuity, and the price that you'd be willing to pay is the dividends that you're receiving divided by your required rate of return, making sure that you appropriately account for the compounding associated with the question. Okay, so that's the zero growth. Pretty straightforward, really nothing more complicated than that, okay? When we look at the dividend growth model, okay, where we've got consistent dividends that are being grown every time period, okay, then we can look at that present value formula just like we were doing from that 1 period, 2 period, 3 period, 4 period, infinite period, if you wanted to so do that. Okay, and we can see that the price we'd be willing to pay is the sum of all of those future dividend payments, right? That's what we've been doing. So all we're doing is just like you did with the project valuation on the midterm, all right, taking each of those future cash flow streams of the project, right, discounting them back into today's dollars, right, and then summing everything up, right? That question on the midterm, what's the sum of the 10-year present values, okay? Well, that's the price you would have been willing to pay for the project, right? You've already done this. This is exactly what you've already done. You did this on the midterm. You calculated the future value of the project, what it was delivering to the firm. You brought it back into today's dollars using the discount factor, 1 over 1 plus the rate to the time period. You calculated the present value for each of those time periods, right? And then you added them all up. That was a question on the exam. What's the sum of the 10-year present values? Well, that's exactly what this is, right? The sum of all of those present values is the price you'd be willing to pay, period. Plain and simple, done. Future value equals present value times 1 plus rate to the time period. And all we're doing is flipping things around to be another present value calculation. Okay. So when we do this, okay, and we start adding in a growth rate, okay, our dividends are going to grow, right? The dividend growth model. Well, now if we take D1, right? So that's the dividends in a year from now that we're going to get paid, right? So that's the future value. That's the future cash flow stream coming in the door for that dividend a year from now. Right, so let's convert D1 into D0 in a growth rate. How do we get to D1 based upon a dividend that we just got paid? Okay, so when we say a dividend of $1 was just paid, All right, that's telling us that we're talking about the D0, the time zero dividend, all right, of $1. And we know that it's going to grow at 10%. So D1, meaning the dividend we're going to get a year from now, okay, is nothing more than what we just got paid times 1.1, an additional 10%. It's going to grow by 10%. So D1, okay, the dividend a year from now is nothing more than the dividend we just got paid, okay, times 1 plus the growth rate. Okay, so we know that as long as we know we just got paid, we can layer in this new growth rate, okay, just like we did with the D1s and D2s and D3s. So the dividend in year 2 can also be written as D0, what we just got paid, times 1 plus the growth rate to the second power. Okay. Why is that? I want to go back to this. And this is where I need you guys to really think critically about that super simple future value equals present value times 1 plus the rate to the time. Okay. I want you to look at this right here. Just that, D0, 1 plus G to the 2. Why does this equal D2? Okay, so D2 is equal to all of this. Somebody in the chat room put the formula in the future value formula terms for those two components. And I'm not going to say a word until somebody participates, because this is crucial. This is crucial for you to understand how these relate to one another. Okay, because it all ties back to that future value calculation that we talked about in week 2 or week 3 of the semester. All right, so I'm going to stop talking and be silent while you guys think about, you get D2, think about what D2 is in relation to that formula, and think about what D0 is in relation to that formula, and think about what G is and what 2 is, and then somebody tell me in the chat room in formula terms. I want you to write the future value calculation for those components. I'm going to go grab my Apple Pencil and see if I can get my whiteboard on my iPad to work today while you guys are still thinking. Is D2 considered to be the FV? Yes, Taryn. Yes, that's exactly right. Okay, that's awesome. All right, you got the piece. All right, so D2 is the future value. Keep going. See if I can share my other screen here. Okay, just somebody hit me in the chat room. Everybody see that okay? Everybody see my little D2 equals question mark? Somebody let me know you can see that, please. It's blurry. Okay. Well, I don't know how to fix that part because it's probably blurry just because it's trying to project through Wi-Fi, but I'm going to keep going here. Okay, so Taryn just told us, right? Taryn just told us, okay, that D2 represents the future value. D2 represents the future value. So when we think about the future value calculation, we know that, right? We know we got that, correct? Okay. So if we think about what we saw on the slide a few seconds ago, right? And we thought about how we are growing that dividend from what the dividend is today, okay? Then we can look at what's the present value of that dividend, all right? So it's whatever the dividend is today, correct? So now we've got, because Taryn told us, we know that FV is D2, right? We're talking about the second time period here, but it applies to every single other time period ad infinitum to infinity and beyond. Thank you, Buzz Lightyear, one of the greatest movies ever made. Right? D2, we know is equal to whatever the dividend that we just got paid is. So the present value of D0, right? Times 1 plus, now what's our rate? Our rate is the growth rate of the dividend. 1 plus our growth rate to whatever time period it is. Okay, so we just can now see, all right, we just now see, okay, where this comes from. It's not, you know, witchcraft and wizardry. It's just math, and it's rearranging the same future value formula, okay, that you're used to seeing. D2, like Taryn just told us. Okay, Taryn just told us D2 is the future value of the dividend, right? Exactly, because that's the dividend that you're going to get 2 years from now. So that's the future value of the dividend. And then we said, all right, well, how do I translate that into present value dollars? Well, D2 future value is equal to present value times 1 plus a growth rate raised to the time period. So we're using the formula twice, right? We're using this present value formula twice. Once to figure out what is the future value, okay, in terms of today's present value and a growth rate of present value dollars. So we're calculating the future value, okay, of the dividend using the time value of money formula, okay? And then we're using the time value of money formula again to determine what the present value of that future dividend received is at our required rate of return, okay? It's nothing more than what you've already done. You have done everything that relates to these calculations. It's just a matter of understanding it, okay? All right, so D2 is the future value. And if we want to know what D2 is in terms of today's present value, we use the time value money formula. So we can take all of this, okay? And trust me when I tell you this, if we were in the classroom, I'd actually show you how to derive it, but I'm not going to do it. If we take all this, we can simplify all of this into one very easy formula, okay? And when we do, here's what we get. On a constant dividend growth model, the price today, the P0, okay, is equal to the dividend. This is very important. Words matter, okay? This is very important. Words matter, okay? Because if you're going to make a mistake on the exam on Tuesday, this is where you're going to make it. The dividend that was just paid, not the dividend that's going to be paid. The dividend that was just paid times 1 plus the dividend growth rate divided by your expected rate of return minus the growth rate. Okay. If you rearrange all of this and you do the series work here, okay, and you bring it all together, this is what you come up with. Okay. And we can take it one step further. And this is where words matter. okay? If I give you a question and that question says the last dividend paid was $1 and it's expected to grow at 10%. The words just paid tell you that we're talking about D0, okay? And that you need to adjust that for the growth rate. If the words that are used are the company is expected to pay $1.10 a year from now, I'm giving you through those words the dividend 1 year from now, and you don't need to adjust for the growth rate. So if the words are the dividend was just paid and there's a growth rate, then you've got to adjust. If the words are the expected dividend a year from now is whatever, you don't need to adjust. So D0 times 1 plus the growth rate, that is the future dividend a year from now, right? Just math, divided by the expected return minus the growth. Okay, so here's a good example. So Big D just paid a dividend, okay, keywords, just paid a dividend of 50 cents a share. It's expected to increase its dividend by 2% per year. The market requires a return of 15%. What should the stock be selling for today? Okay, constant growth dividend model, just paid. So P0 is equal to the dividend that was just paid, D0, times 1 plus the growth rate, divided by the required return minus the growth rate. Okay, we can offset the required return because we know the dividend is growing by 2%. So the dividend is kind of offsetting a portion of our required return, which means that the price that we are paying today, or that we would pay for today, is $3.92. Okay, so constant dividend growth model. Okay. Second example, again, words matter. Pirates Inc. expected to pay a $2 dividend in 1 year. In 1 year, they're already growing it. They've already grown the dividend. So we're looking at D1, not D0. Okay. Expected to grow at 5%. What's the required rate of return? What, 20%? What's the price? $2, D1, use D1. See, we're not adjusting it for growth. It's already been adjusted. Divided by your required return of 20% minus the 5% growth rate. And you get $13.33. Okay, so this final sub-bullet here, why isn't the $2 in the numerator multiplied by 1 plus the growth rate? It's because it's already been factored in. Is expected to pay $2 in 1 year. They've already grown it by whatever they're going to grow it. Okay, so words matter. Just paid, D0. Expected to pay, D1. Okay. So this is just an example of price sensitivity to the dividend growth, and it makes a lot of sense when you look at the fact that obviously it's exponential in shape, okay, because we're dealing with the future value calculation, the time value of money calculation, which has time frame, okay, as an exponent, and we're talking about the sum of all the present values. And by having an exponent within that equation, within that formula, within that model, you create that exponential shape to the curve, just plain and simple, just like you saw with the bonds. Okay, so there's the growth rate, and you've got stock price. Okay, so you can see again exponential in nature because it has to be. Okay. All right, Gordon Gruth. Let's talk a little bit about this company. They're expected to pay a dividend of $4 next period. Okay, and dividends are expected to grow at 6% per year, and the required return is 16%. What's the price you'd be willing to pay today? Right. Well, we know P0 is equal to something divided by our rate of return minus our growth rate. So we've got rate of return minus growth rate on the denominator. So what goes in the top? Well, it's expected to pay a dividend of $4. It's already been adjusted. So we have 4 divided by 16 divided minus 0.06, and we get $40. That's what we're willing to pay today. we've already adjusted the dividend for the growth rate. So we're dealing with D1 already. Okay. If this had said just paid, Gordon Growth Company just paid a dividend of $4, then we would have to take the $4 and adjust it by 1 plus the growth rate. Okay. But it's already telling us it's expected to pay a dividend next period. So down the road, it's going to pay $4. We've already adjusted it. Okay. So what's the price expected to be in the 4th year? Okay. Well, the price in year 4, remember, present value, future value, pretty straightforward. So what's the price in year 4? Well, P4 is equal to the dividends that you're going to get in D4 times 1 plus the growth rate divided by the rate of return minus the growth rate, which is also equal to the 5th dividend period, right? The dividend in year 5 divided by the rate of return minus the growth rate. So when we do all that, okay, we get $50.50 as the price of year 4, period in year 4. Right? So what's the implied return given the change in price during the 4-year period? Well, started at 50/50, okay, equals 40, 1 plus the return to the 4th power. Therefore, you solve for the return and you get 6%. Okay, so you're basically shoving this into Excel with the future value, the present value, and the NPER, number of periods, and you're using the equals rate calculation in order to determine the rate of return. Okay, you're doing the same stuff you've already done. Okay, just looking at it through a different lens, applying it in a different way, right? But you're using the same time value of money concepts in order to do this. So in this case, what we see, okay, is that the price is assumed to grow at the same rate as the dividends, which, guess what? That makes perfect sense if what we've said holds true, and that the future value, the sale of that stock at an infinite point in time in the future is essentially 0, then the value of the stock, the price of the stock, is changing at the same exact rate as the growth of the dividends, because that's the only thing that the stock price is made up of, is the sum of all of those present values of future dividend payments. And if we're on a constant dividend growth model, each one of those successive dividend payments is growing at the same rate. So if each one of those successive dividend payments is growing at the same rate, then the stock price must also grow at that exact same rate, because there are no other factors involved. Okay. So I'm going to talk about non-constant growth, okay, because I think it's important for you to see how it works. But I'm not going to test you on non-constant growth come Tuesday. Okay. So let's talk about a firm that's expected to increase dividends by 20% in 1 year and 15% in 2 years. And then after that, the dividends are going to increase at a rate of 5% indefinitely. Okay. If the last dividend, D0, was $1 and the required return is 20%, what's the price of the stock? Right? All we have to do is find the present value of all of those expected future dividends. That's it. Okay. So all we're doing is something very similar to what you guys did on the midterm with project valuation. We have to find the present value of the future stream of cash flows. And in this case, we know that the first dividend, D1, okay, a year from now, is simply D0 times 1 plus the rate to the time period. Time period's 1. It's 1.2. Okay. So that's the dividend in year 1. We know that it's going to grow in the 2nd year, okay, by 15%. Right? So we take the $1.20, we know that, okay, and we add 15% to it. So the dividend in year 2 is $1.38. So we know that's going to be the case. Okay. Again, nothing but time value of money, right? The present value, 1.2 times 1.15, all right, is 1.38. That's the future value. Done. You're over in that very discrete time frame. Okay, it's the same stuff. We're growing it at 15%. Okay, $1.38. And then we said after that, it's going to grow by 5% consistently. So we know that in the third year, at the end of the third year, we will have a dividends of $1.449 per share that will consistently grow at 5%, for eternity. So what's the future price? Okay. So the price in the period is D3 divided by the rate minus G. So what's the price out here that relates to this dividend payment? Well, when we do the work, 1.449 divided by 0.2 minus 0.05, rate of return minus our growth rate, we see that in that period, it's 9.66. Okay. So our price at time 0, okay, is the dividend that we got paid, right, the $1.20, future value divided by 1 plus the rate to the time, plus the $1.38, okay, in that second period, D2, plus the price that we calculated for the second period, 9.66, multiplied by the discount factor, 1 divided by 1.2 to the 2, or future value divided by 1 plus rate to the time period. So when we do that, the price of this company today per share is $8.67. Okay. All we're doing is figuring out cash flows. We know we've got dividend payments, and we know we've got the price of a stock in a given year. So what am I willing to pay today to get those future stream of cash flows? Future value dollars converted to present value dollars, sum it up, and we've got the price. Okay. So when we use the dividend growth model, right, and we're looking to find what the required rate of return is, okay, it's just math. And all we're doing is reorganizing the formula. So we said that P0 is equal to, the dividend we just got times 1 plus the growth rate divided by our rate of return minus our growth rate, also known as future dividends divided by the rate minus growth. We're trying to solve for R. So when we rearrange everything, okay, I'm not going to do it for you. You can do it on your own. We can see that the required rate of return is equal to the dividend we just got paid times 1 plus its growth rate divided by the current price of the stock plus the dividend growth rate. Okay. And all of that, yes, if you take all of this and rearrange it again, you'll get this. Okay. Do it on your own. See if you can see if you can figure that one out. All right. It's not complicated, but you'll get exactly that. And then conversely, we can simplify it a little more if we're already given the next anticipated dividend. So if we're already given D1, then it's just D1 divided by the current price plus the growth rate. That gives us our required rate of return. Okay. So when we look at required rate of return, okay, suppose we got a stock selling for $10.50. Okay. Just paid a dividend of $1. Remember, words matter. And dividends are going to grow at 5% a year. What's the required rate of return? Well, dividends were just paid, which tells us we need to adjust it for growth. So we're using this. Okay. So we've got D0 times 1 plus the growth rate, okay, divided by our current price of $10.50. See, $10.50, okay, plus the growth rate of the dividends. Do all that, our required rate of return is 15%. Plain and simple. Okay. You're going to make one of two mistakes when you get to the exam on Tuesday. One mistake we've already talked about, and you're not going to have read the problem correctly. Okay. And you're not going to read that it said just paid. So you're either not going to grow this dividend the way it needs to be grown, all right? Or it's going to say it is expected to pay in the future $1 dividend, and you're going to try to grow it, even though you've just been given that is the future dollar. So you're going to get D0 and D1 confused. That's one way you're going to make a mistake. The second mistake that you're likely to make, if you're going to make one, okay, is not properly putting your order of operations into Excel, okay, by not doing the formula properly. Okay, that's the other way that you might make a mistake. So what's the dividend yield? Well, it's the dollar amount of dividends divided by the stock price. Okay, that's the same thing as current yield for the bonds. So we have dividends 1 times 1.05, that's our new dividend rate, divided by 1050. So we got a 10% dividend yield. That's pretty good. Okay, probably comes with a lot of risk, but that is the deal. So what's the capital gains yield? Well, that's the growth rate, 5%. Right, easy peasy. All right, so let's move from any questions on the dividend growth models. All right, how we go about calculating stock prices based upon the present value of all the future dividend payments. Okay, and like I said, I'm not going to test you on non-constant growth. All right, you're welcome. You guys can all thank me later. So we're just going to keep it simple to either zero growth, okay, and constant growth DGMs. All right, if anybody's got questions, hit the chat room and I'll come back and answer them as we move on. Okay, so stock valuation using multiples. All right, so another way that we go about calculating stock prices, okay, is using multiples. All right, price to earnings ratio, if you'd like to call it that. Okay, so we will come up with some sort of benchmark price to earnings ratio, okay, in order to help us come up with the stock price. Okay, so for example, we look at the airline industry as a whole. Okay, and as a whole, for all of the businesses that are publicly traded that are associated with the airline industry, okay, and based upon the earnings per share of all of the companies within that basket and all of the stock prices for those companies within that basket, and we take stock price and we divide it by earnings per share, we come up with, this is very simplistic, we come up with a benchmark price to earnings ratio. Okay, stock price divided by earnings per share gives us PE ratio. And it's a benchmark that we can then use to kind of get an idea of what should an individual company within the airline industry, what should be trading at based upon the sector average PE ratio and its own earnings per share. So it gives us an idea. So the benchmark PE ratio is often an industry average, okay, just like we just said, okay, or it's based upon the individual company's history of operations, okay. Over a period of time, obviously you can track price to earnings ratio for your own specific company, so it could just be an average, a weighted average, an exponentially weighted moving average, a geometric average, an arithmetic average, whatever. It could just be related to the specific company. Okay. As it relates to how to determine the stock price. So if we look at an example here, just using price to earnings ratio, and again, it's like super simple math, okay? Stock price equals PE ratio times earnings per share. Okay. We could rearrange all of those things and calculate any of the different variables, but we could also say price to earnings ratio, PE ratio, is equal to the price that the stock is trading at divided by the earnings per share of the company. Okay. So we got EPS at $3. The sector average is 12. Okay. What's the stock price? What should the stock price be if the company, right, is trading at the PE ratio, the multiple equivalent to the sector average? Well, the multiple is 12. PE ratio is the multiple, that's 12 multiplied by EPS of 3. Therefore, the stock price should be 36 bucks a share. Okay, if they're trading at the sector average multiple of 12. Okay. So the price at some point in time is simply nothing other than the 12 multiple, your PE ratio multiplied by the $3 earnings per share. Okay, straightforward, not complicated. Right? So in general, this is a table that's in your text. I encourage you to read it over, but don't just memorize it. Like really think about what it means. Okay, because like Taryn said, and it took, I don't even know how many minutes it took before, Taryn came in and got that right about D2 is considered the FV. Okay, you need to think about, what does this mean? What does this look like? If I just took this first period here, what is that? Right? What does this even represent? Well, it ought to be really clear to you, because this looks a whole lot like present value is equal to future value divided by 1 plus the rate to the time period. Okay, that ought to look real familiar. Okay, so should the second time period, and so should the third time period, because guess what? You did this on your midterm. When you did the project valuation, this was year 1 of your pro forma operating cash flow. Okay, that's what that was. And year 2 operating cash flow, and year 3 operating cash flow, and you had a discount rate, and you had a time period, and you calculated the present value, okay, of each one of those as the future value times the discount factor. So you calculated a PV1, you calculated a PV2, you calculated a PV3, okay? And then one of the questions was, what's the sum of all the present values? What was the sum of all of this, right? You did that all the way up to D10. And you gave an answer. What's the sum of all the present values? And you gave me this answer. You gave me P0. What's the project worth to me today? Yes, Taryn, I'm going to give you a number of questions that you're going to go through, and you're going to calculate these and Connect before the check-in exam. Okay, so within Connect, I'm going to be posting a homework assignment that relates to Chapter 8 that you'll be doing all of this work within Connect. So you'll have plenty of time to practice in Connect, okay, related to the dividend growth models, the constant growth model, the zero growth model. If you want, I'll throw one question in there that deals with non-constant growth, okay, just so you can maybe get a feel for how that works. All right, but I'm not going to test you on it on Tuesday. Okay, but if you want to understand a little bit more when we get into Business 317 in your junior year, and you take my class, if I'm still teaching at Coucher, then we'll talk more about the non-constant growth model, okay, because it's a little more realistic than the two very simple models that we've talked about. Okay, but nonetheless, you've done all this. Okay, we've talked about this for weeks on end. We've already talked about it. Okay, just not through the particular lens of using what you already know in order to calculate a stock price. Okay, so substitute present value, okay, for stock price, and you already understand it. Okay? So this is the general case, right? That's what we're trying to do. This is the basic math of everything. Under a constant dividend growth model, okay, we know that it's the future dividend divided by the rate minus the growth rate that gives us the price today. Okay, again, you can do the math. We could derive. You can go derive it if you want to. I'd do it on the board for you if we were in the classroom. But nonetheless, just trust me that if you do all of that, okay, and you break it all down, then this is what you come up with. All right. So the price today, the present value of the stock price, what you'd pay today, is nothing more than the future dividend divided by your required rate of return minus the growth rate. Okay, that's the dividend growth model, DGM. Okay, and then you can see the non-constant growth formula there. It's the same stuff. Remember, it's the same thing, right? Except you're factoring in some future price, okay, of the stock in the future. You're factoring in being able to sell that stock at some point in time in the future. Okay, so you're bringing in that future value of the stock at the same point in time that you get that final dividend payment. So very similar, almost exactly like a bond, right? You've got all of the sum of all of the considered coupon payments, right? The dividend payments, equate those two to be the same. Okay, you got the sum of all of those for all the different time periods, and then you've also got the present value of the future sale of that stock at whatever price it's at. Okay, and then it gives you the, what the present value, what the price is at that point in time. Okay. So under non-constant growth circumstances, you bring the final value of that stock price into the equation to calculate what the present value of the stock price is. Okay. And we talked about two-stage growth. Well, we don't want to talk about two-stage growth, but it's basically when, and I'm not going to test you on this either, but if you've got dividends that are going to grow for a specific period of time at the same rate, okay, and then it's going to change a growth rate after that period of time, that's what we call two-stage growth. Okay, so just spend some time thinking about it, because the more you understand what's going on here, okay, the easier it's going to be for you to apply, all right, what you've learned. Okay, this is also fairly common, in the industry. Okay, that you'll have kind of a two-stage growth model, and certainly a non-constant growth model. Okay, some companies are really good about sticking to constant growth. All right, and those are great companies to be invested in. Others, they, based upon the operations or the economic cycle within globally, or what part of the business cycle you might be in, you might experience some of this non-constant growth within the companies you're invested in. Okay, valuation using multiples. The price of the stock at a given point in time is equal to the benchmark PE ratio multiplied by the earnings per share of that company at that point in time. Okay, very straightforward. Okay, you've already kind of done this in some of the questions that you've had, right? What is the PE ratio? The stock price divided by, okay, the earnings per share. Okay. Conversely, I could ask you to calculate what earnings per share is, right? And you would just simply take the price of the stock, and you would divide it by the PE ratio, and that gives you EPS. Okay, so you can calculate any of the three variables depending upon what you're given. Okay, and then we talked about what's calculating the required rate of return. Okay, where the required rate of return is nothing more than the dividend that you're going to get paid in the future, D1, divided by the current price of the stock plus the growth rate. Okay, the capital gains yield, which is the same thing as the growth rate in dividends under the steady state model. Okay, so that's it, right? That's today. Okay, we have an exam on Tuesday, check-in exam on Tuesday. All right, worth 100 points, 10% of your grade. Okay, it's going to cover chapter 7 and chapter 8. You're going to have 10 questions that deal with bonds, and you're going to have 10 questions that deal with stocks. Okay, and you're going to need to understand how to calculate the price of a bond. You're going to need to understand how to calculate the yield to market of a bond, which is nothing more than the rate calculation. Okay, you're going to understand some of the different components of the bond terminology: coupon, coupon rate, maturity, okay, yield to market. You understand yield, current yield versus yield to market, premium bonds versus discount bonds. Okay, if the yield to market is higher than the current, the coupon rate of the bond, is that a premium bond or a discount bond? You need to understand the mechanics of all of that. Okay, and I say 10 questions from each chapter. It might be 15. I'm still working on like what the appropriate length is, because I'm going to give you guys 3 hours to take the exam. Everybody gets 3 hours. Normally you just have 2, but I'm going to give everybody 3 hours simply because, we're in different times, and so hopefully we'll get back to being on campus in the spring and we can get back to more normalcy. But you'll have 3 hours from 9 to 12. It'll be on Connect. At noon for everybody. It will auto submit wherever you are within the exam. Again, like I said, you'll have access to the lecture notes, you'll have access to the lecture slides, you'll have access to the ebook on Connect. You won't have access to like the hints and things, but you'll have access to your ebook. But just simply, again, you can use whatever you want except your classmates. Okay. Any questions about today? Any questions? Nobody? No questions?